You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. At Fidelity, you'll always get a great value for your options trades. And with powerful investing tools that provide clear next steps, plus independent research and a wide range of investment types, we can help you make better trading decisions. Learn more about options trading with Fidelity at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC.
Good morning. Today is Friday, November 9th, 2018. This is your Options News Rundown. I'm Dan Passarelli. Our first story today is from investing.com. It's the top 5 things to know in the market on Friday. The first thing to know is the Fed is on track to steadily raise rates. The Federal Reserve held interest rates steady on Thursday, but remained on track to continue gradually raising interest rates. The central bank has hiked U.S. rates 3 times this year and is widely expected to do so again in December. Expectations of a rate hike are priced in around 80% according to Investing.com's Fed Rate Monitor tool. While there were few changes to the central bank statement, the Fed's new assessment of business fixed investment received some attention. The growth of business fixed investment has moderated from its rapid pace earlier in the year, the Fed said in its statement. That contrasted with business fixed investment has grown strongly in the September statement. The change indicates that the Fed sees some moderating of the economy, but is content with its slow, steady rate hike pace. The second thing to know today is Wall Street is poised for a weaker open. Global stocks were lower on Friday as expectations of a Fed rate hike and weak Chinese data dampened demand for riskier assets. Third thing to know today is Walt Disney beat earnings expectations. Walt Disney Company will be closely watched during the open after it beat Wall Street estimates on the top and bottom lines on Thursday. The company said after the bell it earned $1.48 a share on revenue of $14.31 billion. Shares rose 1.72% in pre-market trading. Other earnings results in focus on Friday are numbers from defense company Rockwell Collins, Chase Corporation, and GNC Holdings. Fourth thing to know today is PPI and Michigan sentiment are expected. The Labor Department released its latest measure on wholesale inflation at 8:30 a.m. Eastern Time. Economists predict that the Producer Price Index rose 0.2% in October, the same as the month before. Core PPI, which excludes volatile food and energy prices, is forecast to have risen 0.2% last month, also the same as September's reading. At 10 a.m. Eastern, the University of Michigan will release its preliminary measure of November consumer sentiment. On average, economists expect the index to drop down slightly to 98. The fifth thing to know today is oil prices are flat on supply concerns. Oil prices were flat on Friday as rising supply and concerns over global economic slowdown spooked investors. West Texas crude oil futures fell 1.78% to $59.59 a barrel, while Brent crude futures, the benchmark for oil prices outside the U.S., decreased 1.6% to $69.58. Data on Wednesday showed that inventories in the U.S. continue to rise more than expected, leading to concerns of oversupply despite sanctions against Iran. Our second story today is from CNBC.com. U.S. Treasury yields are lower after the Fed decision, and economic data is in focus. U.S. government debt prices ticked higher on Friday as traders digested comments from the Federal Reserve. As of 5:30 a.m. Eastern Time, the yield on the 10-year Treasury note was seen trading lower at around 3.206%, while the yield on the 30-year Treasury bond dipped to 3.4%. Bond yields moved inversely to prices. The yield on the 2-year Treasury note hit its highest level since June of 2008. That happened on Thursday, following the latest monetary policy decision from the Fed. The U.S. Central Bank left rates unchanged as expected, but stuck to its guns on its tightening path, saying it saw further gradual increases ahead. Our third story today is from CMEgroup.com. China. Is the trade war's impact overblown? For all the deliberation on the China-U.S. trade dispute, there is scant evidence that the tit-for-tat tariffs are having any significant impact on China's growth. The country's official growth rate did slow down from 6.7% to 6.5% in Q3, but it was just 0.1% below the consensus estimate. The Li Keqiang Index, an alternative barometer of China's economic performance based on rail freight volumes, electricity consumption, and growth in bank loans, showed that further growth is much stronger, closer to 9% year on year, although it has slowed slightly. That China's growth has largely shrugged off the trade dispute thus far comes as little surprise for several reasons. First, U.S. tariffs have only just begun to bite, so whatever impact will likely not be fully reflected in China's data for several more months at the soonest. Secondly, the proposed tariffs just aren't that big in relation to the size of China's economy, the second largest in the world behind the United States. Ignoring second-round effects, a 10% tariff on $200 billion worth of goods in a $12 trillion economy should only erase about 0.1% or 0.2% from China's growth. Third, China can and is taking action to offset those negative impacts, however modest. China's apparent resilience is great news for commodity producers. As we have highlighted in our past research, nearly all commodities, from agricultural goods to metals and energy, have demonstrated significant lagged responses to fluctuations in Chinese economic growth, especially when using the Li Keqiang proxy measure for GDP. That doesn't mean, however, that those who are long commodities are in the clear. Some of the actions that China is taking to offset any negative impacts from the trade dispute could have negative short and long-term consequences for commodity investors. And that, ladies and gentlemen, is news you can use for today, Friday, November 9th, 2018, your Options News Rundown. I'm Dan Passarelli. Trade smart and have a great weekend.
Thank you for listening to the Options News Rundown. To learn more about these stories or any other developments from the world of options, visit www.theoptionsinsider.com, the premier source for free options information. The Options News Rundown is brought to you by Market Taker Mentoring, the leader in option trader education. Get trader education, daily trade ideas, and more with a free 1-week trial of Market Taker Mentoring's live Advantage group coaching class by visiting markettaker.com/insider.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.